Your base salary counts toward a mortgage the day you start the job, but your bonus and commission income do not. And that surprises a lot of people who earn most of their money that way. My name is Anthony Ferrando. I do mortgages for a living, and I want to walk you through how lenders actually count variable income, because the rules are specific, and knowing them a year ahead of time can dramatically change what you qualify for. With variable income, the core rule is history. For bonus, commission, and overtime, lenders generally want to see you receiving that type of income for 2 years. Not necessarily 2 years at the same company, but 2 years in the same line of work, documented with W-2s, pay stubs, and sometimes even tax returns. Some files get approved with just 12 to 24 months of history when everything else is strong, but 2 years is the standard, and under 12 months usually counts for nothing. Once you have the history, the math is an average. So let's say you earn an $80,000 base and your commissions were $30,000 in 2024 and $40,000 in 2025. The lender will average those 2 years and count $35,000 a year as qualifying income on top of your base salary. Depending on interest rates and your other debts, that added income can be worth roughly $100,000 or more of purchase power. It's a big number to leave on the table by not documenting it correctly. Direction matters just as much as the average, though. So if your commission is trending up, it went from $30,000 to $40,000, then you get the 2-year average. But if it dropped from $40,000 in 2024 to $30,000 in 2025, the underwriter will usually use the lower, more recent number. And if it's following fast, like if it went from $40,000 to $10,000, they may just not count the bonus income at all. You don't get to just point at your best year and say, hey, let's use that. The file gets built on what is most likely to continue. Your employer plays a part in this too. The lender will send a written verification of employment that breaks out base, bonus, commission, and overtime separately. And it also asks whether the income is likely to continue. A payroll department that answers not guaranteed on the continuance question creates a problem that your loan officer has to document around. It's fixable, but it's better to know about these things early. One other thing worth planning for. If you just took a new job with a heavy commission structure, that commission most likely cannot be used yet, even if the offer letter promises big numbers. You'd qualify on just your base pay until the history builds. And sometimes that means buying a smaller house now. Sometimes it means waiting a year, or, sometimes a guaranteed draw or salary actually is enough to qualify. And if it's enough to qualify, it's pass fail, then, you're good to go. You don't get a better rate just because we can use your commission. You're just able to buy more of a house. Now, if a chunk of your pay is restricted stock units, those have their own separate 2-year logic, and that's worth its own conversation. The honest trade-off is variable income earners carry more documentation burden and get less credit for a recent hot streak than often feels fair. But that's the cost. The benefit is that once those 2 years are on paper, the income counts fully, just the same as your salary, opening up the options for homes you could potentially purchase. So if you earn bonus or commission and you want to know exactly what a lender would count today, schedule a discovery call and I will run your income calculation the way an underwriter would.